Antonio, welcome to the show.
Great being with you, Brandon. Thanks for having me.
Let's dive right into it. Your bio says you founded Comunidad to honor your family's immigrant heritage, but why did you choose to focus on real estate? Maybe walk us through the origin story of how you started Comunidad.
Yeah, Comunidad was really started, with this vision of what could happen when you have, someone that has a background that's diverse, that comes from an immigrant, family, and wants to really kind of reimagine housing, reimagine how you think about community and community development, and doing it in a supportive way, and also doing it in a sustainable way that also has an economic, outcome that's also favorable. Not only the social piece. And for me, it started at a very young age. My father was a Hispanic immigrant. He came to the United States at the age of 17. So he came to the United States not speaking the language, really, looking for his version of the American dream. And that version was just to provide, a better life than he had in Mexico. He's from Jalisco. He came from abject poverty. And he, worked in California. He was a farm worker. This is kind of pre-Chavez. So, before civil liberties and workers' rights and that sort of thing. So very harsh working conditions, particularly for an immigrant that didn't speak the language and is trying to find his way. But, through grit and perseverance and believing, and having the promise of the American dream, he ultimately scraped together enough change to start a company. And he started that company out of his garage. And his company was really kind of importing and distributing Hispanic grocery products. So this was back at a time where there wasn't a lot of kind of ethnic Hispanic grocery items in a lot of grocery stores. There was this burgeoning demand that was coming from kind of the Hispanic demographic. And I always remember this, growing up as a kid, he'd go to Bentonville, Arkansas to talk to Walmart. He'd go to Cincinnati, Ohio to talk to Kroger. He'd go to Provo, Utah to talk to Albertsons. And, none of those chains understood the product, and because they didn't understand the customer, because that wasn't their, at least at that time, they didn't realize that could be their customer. So it was really a lost market opportunity for them. But he started like little mom and pop stores and kind of built it. And then ultimately got into, a chain that really understood the demographic, understood the growth pattern. That basically changed the trajectory of him and my family. And it just took that one buyer at that one chain store that really could transform, an immigrant family like that. And I wouldn't be sitting here if it wasn't. And so a lot of that appreciation and gratitude for the opportunity that my father had, and ultimately, made something of. I wanted to do something in my own way, because he had his own success building a wholesale grocery distribution firm that sold to retailers, and he also bought real estate. So he bought industrial real estate to warehouse the grocery items that he was distributing. He was also vertically integrated, and so I was the first one to graduate college on that side of the family. I had an affinity for commercial real estate. And I also grew up building businesses. So it was really kind of this mixture of building businesses, investing in real estate, doing something where you were really passionate about doing it in communities that you understand, with a customer that and have an acute understanding of. And so I took all that and said, well, how can I apply all this into the commercial real estate space, and more specifically multifamily? And it became very, very clear and apparent to me. It was just like one of those aha moments, right? A very serendipitous, is like multifamily housing in culturally diverse neighborhoods with social impact, right? Because there was really no one doing it. And it just seemed so obvious to me. So that really charged me in terms of, formulating strategy and the genesis behind Comunidad. And when you really look at us at our essence, we're really trying to kind of pay it forward in a meaningful way, because a lot of these communities that we serve at Comunidad are the communities that were instrumental in my family's success with their businesses, but also doing it in a way that we can provide a service, an experience for our residents that's really value add. So a lot of our strategy revolves around how can we help our residents elevate in their lives, find better opportunities, and looking at multifamily as more than just shelter, but looking at it as more of a vehicle for opportunity for many residents. And that's kind of been our investment thesis. It's paid a lot of dividends, and we've been able to scale it. And here we are 15 years later and still sticking to our knitting.
It's an amazing story. Let's make sure that we hit on a few points. So first of all, for those of our listeners that don't know, what does Comunidad mean? Why the name Comunidad?
Well, Comunidad means community. But the reason that we chose Comunidad is because it represented what we mean. It's a very simple word, right? But it can mean a lot of different things. And for us, it meant how can we engender this sense of community in the multifamily apartments because a lot of times we think of, real estate as sticks and bricks and the built environment, right? And we get caught up in financial engineering, and we get, CapEx and construction and, all the different aspects, financial and capital markets. But I think as an industry, we lose sight of what are we really doing? What is our real kind of, purpose and value add? And if we really think about it, it's the customer that we're serving and the community that we're building. And if you do that the right way, if you're really kind of attuned to the wants, the needs, the cultural idiosyncrasies of your tenant, irrespective of if it's a workforce housing strategy or if it's an office strategy or if it's hospitality, strategy, that's when I think you really actually are able to derive value and support what you're really doing from an investment strategy perspective. So that's why we kind of, started with Comunidad. It's very simple. It's spelled with one M, by the way. We always get people spelling it with two M's, but in Spanish, it's one M. But it really means, how do we focus on people and community and doing it in a way that really drives value for all stakeholders.
So here you are, you're the son of an immigrant who came to this country escaping abject poverty. You grew up, as you said, investing in running small businesses yourself, whatever that means. And maybe you can share with us kind of some examples of those.
Oh, I've got plenty.
And you mentioned that, you realize that you want to give back and you want to do something, like do something to benefit the community that you and your family benefited from. But one of the common challenges is how do you bring more diversity into our industry at a leadership level? So how did you kind of become acquainted with this idea of commercial real estate as a career and investment management as a kind of subset of that? Was there a person? Did you have a mentor? Like, do you learn this at school? Did it come to you? How did you choose to develop a career around being a multifamily socially oriented multifamily investor, owner, operator?
If you look back at like my background and where I came from, where my family came from, and then where I am today, this shouldn't happen. It should happen, but odds, say that it should rarely, if ever, happen. And that is the unfortunate part. But I literally pinch myself, all the time, and just am so grateful that I am here. And I frankly, not only is it an opportunity, it's a responsibility, I feel, not only to Comunidad and our team members, but really kind of this whole ecosystem of other talented, diverse individuals that are working in the profession now, or even that are coming, up from high school on, because I didn't know how to make money in commercial real estate. I really didn't. All I knew is that it's one of the largest asset classes in the world, if not the largest asset class. I knew it could be a wealth creation tool. And I knew that particularly in housing, there wasn't a lot of innovation, particularly in workforce and affordable housing. So those were my kind of, North Stars, if you will. And I honestly, when I started, I said, the math I'll figure out. Right. If I really deliver a great product, I'm focused on this space, then I just felt that the natural end result of that would be some economic, outcomes that were positive. And so I didn't have a track record. I didn't have a network, Brandon. What I did a lot was I knew that I wanted to do this because there was a big void, and I felt that we could fill that void in a meaningful way. But what I started to do is just go to conferences, meet people, ask a lot of stupid questions, because a lot of times, stupid questions can have some of the most enlightening responses, and not being fearful about that, right? And being even vulnerable in some cases, because there may have been obvious questions to other people, but that's okay. I wasn't going to have pride to not learn and thirst for getting better every single day. I think that also comes from, you talked about kind of the stories that I had growing up. Growing up in an immigrant family where failure was not an option, and we had to earn everything. That was kind of that fight that burned inside me, that when you're really passionate about something, you don't look the other way. And so, things like, even with, my family, it's like, me and my father would go down to the Mexican border to pick up, some jalapenos and some jarritos and some other goods and items. And then we go and we distribute it, throughout a certain market, just in the back of a van, sleeping in a van, those types of things, where you just build that work ethic. Or, my father, even in high school, after the company started to really grow, and I started really working even in the summers and in more depth. He didn't put me on in a supervisor's position or a position of prestige or anything to that effect. I was literally on the floor, and we had, it was a manufacturing plant. And so I was on the floor sweeping the grounds and mopping stuff up. And those were some of the best lessons. And that really kind of build character, build work ethic, and make you appreciate, things that much more. And so that's all fed into kind of how we've, grown the company and built the company. And I think it's the difference between going that extra mile and doing a little bit more and working a little bit extra to have something that's great, versus being just any other firm and being ultimately a commodity. And that's what we're trying to do. We're trying to decommoditize the space and provide a unique experience and unique product to the market. And it's served us well with that approach.
That's awesome. So here you are, you've grown up in this family, the grit, like we talked about. What is it? 15? We're 15 years in. How long ago did you found Comunidad?
Yeah, 15 years ago.
15 years ago. So what are the headline stats today? And then we'll work backwards. We'll unpack your strategy and what it is that you do. So kind of give us the baseball card, if you will, in terms of your stats today.
Yeah. So we're a vertically integrated investment management firm. We've done about $2 billion in AUM, 15,000 units across 22 different markets, mostly, ACC rehab, but we have also done development, but all workforce and affordable housing. So there's been no mission drift, no style drift, and really kind of at the nexus of housing affordability, ESG, diversity, equity, inclusion, and prop tech is also a big component of our strategy that's kind of interwoven throughout all those other dimensions.
So let's talk about, what is workforce housing, and how is that different from affordable housing?
Yeah, workforce housing, and there's a lot of different definitions, and sometimes it's contextual, but our definition is 60 to 120% of AMI, of area median income, that's established by HUD. And so we use ULI's definition as our standard. And at the end of the day, that's kind of the technical definition. Our kind of entrepreneurial qualitative definition is, if folks have too high of an income to qualify for government subsidy, but not high enough of an income to afford luxury, A-class multifamily, or even to buy a home. They're this kind of missing middle where they're stuck on either end and they don't have any support. We feel that there's a huge need for, an owner-operator firm, development firm, to actually provide for those families and those populations. And so it's something that is on both ends of the spectrum, from A class to kind of affordable, like capital A affordable, which is truly subsidized through project-based Section 8, LIHTC, and that sort of thing. That's where most of the capital has gone historically. And so that's also why there's some inefficiencies in this workforce housing segment, and an area that we focus a lot in terms of institutionalizing best practices, services, again, providing a differentiated living experience for residents, because a lot of other groups are not doing anything outside of just the cookie cutter approach to housing. So that's kind of our definition of the space.
So you touched on workforce, and then affordable is, you mentioned, I think in your answer, it's LIHTC, it's government subsidized. Is that the big difference, which is affordable has subsidies and workforce doesn't necessarily have subsidies from the federal government?
Correct. Yeah, that's the primary distinction.
So where do you invest? And then what does your community look like? It sounds like it's more than just an apartment building where people come to put their head down at night, or where they live. So talk to us about the markets that you're in, and then, the assets themselves and what makes them different versus the commodity product that you mentioned.
Yeah. So from a market perspective, so we're invested in the Sunbelt markets throughout the country. But even when you actually kind of drill into even those markets and MSAs, from a submarket perspective, if you think of like these markets as a kind of concentric circles where you've got this urban core, right, white collar, highest income levels, highest socioeconomic, we're kind of looking for assets that are in the outside of that kind of urban core concentric circle. So suburbs, exurbs, those types of markets. So kind of the gray collar and blue collar. So the folks that are servicing the office buildings, that are in the retail, that are the store managers, that may be at restaurants. Those folks that really make cities and economies operate and hum and productive. Right? When we think back at COVID and pre-COVID, we would get a lot of skeptics of our strategy and said, listen, when there's a downturn, those are the first jobs that are going to go away, right? So you're going to be very vulnerable. And we just don't think that this is a durable investment thesis. And so what happened in COVID was a complete opposite. We saw the value of the essential worker, and the teachers and the nurses and, the medical practitioners and others. And those were our residents. And so, a lot of our strategy revolves around knowing your customer, knowing your resident, understanding what makes them tick. And some of that is having the cultural aptitude to understand that, having, lived experiences that are shared, and then applying an experience that it isn't commoditized, as we were talking before. And, I really look at kind of the real estate itself as a conduit, just really a conduit to providing services and support. And so we'll do a lot of different things. So we have events all the time. So that's one thing. We always want an excuse to have some sort of event or some sort of party or festivity and that sort of thing. And that kind of, matches up with the culture with Cinco de Mayo or El Grito or, Halloween, for the kids and that sort of thing. But even beyond that, beyond kind of the social and fun, we also are thinking about our residents from a health perspective, an education perspective, an equity and economic advancement perspective, because these are the things that families really need to have an opportunity, to have the potential to provide and rise and elevate and get better jobs and better income levels. And my father didn't speak the language, so that was a major impediment to his assimilation. I think some of his opportunity set that he had. So providing ESL, at our communities, and providing not only Spanish, but, depending on the communities and their language, providing ESL that is tailored to what they need. We've rolled out a virtual healthcare program. Many of our residents are uninsured or underinsured. Some of them are contractors and they may not have insurance at all. So they're very vulnerable to kind of the health resiliency. And so for us, offering a virtual healthcare option that provided 24/7 access to nurse and nurse practitioners and doctors, and prescriptions and diagnosis and that sort of stuff, which covered physical and mental health, was a game changer because residents realized that we care, for one, and two, it created a lot of loyalty and built a really sticky experience within our communities. And for us, it made a lot of business sense because if our residents are healthier, then that means that they don't have to take days off of as much days off of work, right? They can work 9 to 5. They can be there for their kids. They can support their families. They're more productive. They're earning more. They're healthier. They're happier. All those things where you actually get the symbiotic relationship. Because we reject the notion that like social impact is kind of there is concessions to that because of what I just described. If you're investing in the right way, you can't do just all social impact indiscriminately. But if you invest in the right social impact investments, and that drives value for your resident, then that also drives value for the property, and that's where that symbiosis and that value add you really complements each other.
And are those services that you offered are they offered by Comunidad, or are they done in partnership with other providers? So take virtual healthcare, for example. Who's running that program?
Yeah, great question. So we started a nonprofit. So we were one of the founders of a nonprofit by the name of Veritas Impact Partners. Historically, we did all of our impact in-house, and we had our asset managers doing impact. We outgrew that. And we realized the need for having a dedicated team, a dedicated resource, a dedicated funding source for these impact services. And so the virtual healthcare is now housed through Veritas Impact Partners. And so they administer the program. They go through the enrollment process with residents. It's all HIPAA regulated, but it's a partnership with Aetna and CVS through Teladoc. Is a service. And so it was a first of its kind of multifamily program that has been a great success. But yeah, it's provided by Veritas, paid for by the property, but also subsidized as well. So we're not paying full freight. But the SROI on it is significant because of the retention and the word of mouth resident referrals, or organic, traffic and leases that occur, because when families are really getting taken care of and they felt that they're getting dignity again, and they're getting support, and they feel like they matter, then they're going to refer all their friends and family, and then that's when it becomes this virtuous cycle.
So how does that, just moving to the real estate side of things a little bit, because I think what you're doing at the asset is extremely interesting and impactful. How does that impact your occupancy? How does it impact your your kind of turnover of units? What do you see from an ROI? You mentioned the SROI, which I think is social return on investment. How about the kind of economic return on investment side of things? Is there a correlation?
Yeah. So, candidly, you're not going to say an after-school program or a virtual health program. You're never going to find this perfect correlation between, this program is translating in this many bips of NOI. But what we have found is that when you look at the continuum of services that we provide in a holistic way, and you compare our assets to the peer set, to a benchmark set that does not provide social impact, and controlling for all other factors, right? So location, vintage, amenities, when you control for all of those factors and they're comparable and like kind, and the only distinguishing trait or characteristic of a property is social impact, we've been able to demonstrate consistently that NOI is high single digit to even, depends on the market, but to low double digit improvement on NOI. And the reason for that is exactly what you said, Brandon. We're able to keep occupancy higher. Our collection rates are higher. We have lower delinquency rates. We have this whole kind of eviction prevention program where I'd probably say I hate evictions. We hate evictions. We really do not like them. It's a complete last resort. We want to keep residents in their homes and ensure stability for them. But what that also does is when we can keep residents in their homes, it reduces our turnover costs and marketing costs and payroll costs and all sorts of other costs. So it all flows to the bottom line, NOI. And that's how we're able to demonstrate kind of the business case and the economic case for this type of strategy.
what you said about evictions, I think is really interesting because you also mentioned that you invest in the Sun Belt. And I've talked to a lot of multifamily, not necessarily affordable workforce who choose the Sun Belt because of their kind of pro landlord rights, if you will, the ability to evict a tenant for non-payment. Can you talk a little bit more about what that program looks like and kind of how it's helped your tenants? And you already talked about kind of what the benefit to your business is, but I think it's interesting just to unpack how you can run a successful business without needing to rely on eviction as a primary mechanism for increasing rents and turning over units.
Yeah, I mean, and I think just fundamentally speaking, you're going to have outsized evictions if you have just bad management practices in the first place, and you do not have great engagement with your residents. You don't have a relationship and communication going on, and so that starts with your sites. And that's one of the other reasons of being vertically integrated and why it's important for a strategy like this. It starts with your site staff. It starts with your regional staff. It starts with your asset managers. But even, me, even during COVID, I reached out to residents. I had, a dozen different residents that I talked to really have a finger on the pulse. And so I think, from our perspective, we want to make sure that we're articulating and that residents are feeling and we're conveying the fact that we care. We have to run a business, right? There are, rules. But we care, and I want that permeated throughout the organization. And so a conversation, if someone is missing rent, for instance, isn't pay rent by this date or else. It's let's have a conversation. What are your challenges in life? And when we really understand and kind of unpack what's going on in that person and that family's life, and we understand, oh, they just lost a job. Well, we've got a partnership with Prologis, and they have vocational skills training, and they've got job placement with, all of their tenants. So Amazon and Walmart and Target and you name it, right? And so those tenants are really looking for employees that fit our demographic, that's our workforce. And so that's one of those, situations where if they're out of a job, we can help place them in a job that in many instances may be better than the last job that they have, and it's more durable, and a lot of times it's higher paying too. So, the whole point is to make sure that you have these interventions and engagements so that you really understand their story and you can help them get back on their feet. And sometimes it's not just job. Maybe it's, we need something else. We need transportation. So let's plug them into the public transportation on a discounted basis. Sometimes it's just food. I mean, it can be as elemental as food. So we partner with food banks to do that. So, it's those conversations first. And that in and of itself, when you have that sort of culture and that relationship, that reduces your eviction risk significantly. Beyond that, if it really, if we have more issues beyond that, we'll look at payment plans, we'll look at rental assistance, we'll work with nonprofits that have rental assistance. Federal rental assistance has basically wound down entirely. So we got to get creative of other, tools. Ususu is another provider of zero interest loans to residents that are having, payment issues. So we really go to great lengths to help them. And when you do, and you get them back on their feet, they're so grateful for that. And you just created a very loyal fan and a resident that normally lives in your property for a long period of time. And that's really our end game, our end goal. We want our residents to live in our communities for a long period of time and support them.
So that's amazing. Thanks for sharing that perspective. You mentioned housing, and you mentioned renters assistance. Let's talk a little bit about the affordable housing crisis in this country. It's a very politicized issue. I know that there's some bipartisan support right now that are providing some tailwinds for the sector. Can you talk about kind of what's happening from your perspective, and why you think this is going to help advance the sector going forward?
Yeah, I think it's a fascinating time in America today, where we have a couple different things. I mean, coming out of COVID, we had this massive run up in rents, which was problematic. It put a lot of pressure on renters throughout the country, and naturally, there was inflation and insurance and property taxes and material cost increases and that sort of thing. So that was part of the challenge. The other challenge is that we just don't have enough supply, and we need to create more. We need to preserve, and we need to create more supply. Fortunately, and this was not the case, I'd even say 5 years ago. Fortunately, many municipalities and localities, local jurisdictions, city council members, planning departments, that sort of thing, get it. Many do. At a federal level, this has gotten a lot of momentum, a lot of bipartisan support in terms of trying to address the affordable housing crisis in this country. And so, from my perspective, I'm actually very encouraged in terms of some of the work that's being done right now at a federal, state, and local level. You've got Senator Wyden, who's a senator out of Oregon, that has actually introduced legislation to really support kind of the creation of new housing. You've got MITEC, which is the middle income housing tax credit, that's being proposed to really support more creation of this product for residents of different income levels. So you can have like more of a mixed income kind of housing product, which I think is hugely beneficial. And then at a local level, you have a lot more cities that are coming in with subsidies, grants, density bonuses, a relief for parking regulations. You have accessory dwelling units, which is a really interesting new space. California's seeing a lot of promise there. And then also property tax abatements. Property tax abatements has been a massive one, can be a game changer. It's the difference between being able to produce affordable housing or producing luxury housing that's going to displace. I mean, it's as simple as that. And you're seeing a lot more, again, local jurisdictions that are adopting that under a nonprofit structure or PFC structure, much of which we've actually adopted at Comunidad, and that has allowed us to kind of preserve housing and maintain rents at affordable levels. So there's a lot of movement happening in that space, and I'm you can't always say this in politics, but I'm actually pretty optimistic about the long game. The short game is going to be a challenge, as it always is, when you've got to make this sort of transformative shift. But from a long-term perspective, I'm pretty optimistic.
So before we can benefit from the long term, what is the current kind of near-term horizon zero market fundamentals? What's the environment today on the ground, kind of operating in this, with this housing affordability crisis all around us, trying to build product, manage product, and invest in products that doesn't always exist. So what's the market like? What's happening on the ground? Tell us a little bit about, give us a sense of where cap rates are, what the supply side looks like, and any kind of details that you can on kind of recent transactions or kind of how the market's performing given the kind of current macroeconomic conditions.
Yeah. So we just, there's a Wall Street Journal article that was just released that the multifamily industry experienced the first dip in rents in, I think it was 7 or 8 years. So it's been a very long bull run, maybe with exception to one period, but it's been a very long kind of trajectory in terms of where the growth has been. And so you've got that in conjunction with capital markets disruption. And so, transaction velocity has fallen off a cliff, largely, due to just where interest rates are at, plus I think eroding fundamentals and just, capital, although, there is a lot of capital out there. It's just not being put to work just because there is this kind of recalibration that's occurring in the market. And so from my perspective, I think one of the bigger concerns in the workforce and affordable housing space is that, the owners that currently own assets will probably not continue to invest into them. And that will degrade kind of the physical plant and the communities themselves, and also, potentially put the affordability at risk. If some passive owners are now really trying to push rents, it may be hard for them to do that, but they may be more inclined to do that in this particular instance. And the folks that were already aggressive probably have already created a lot of displacement and are probably, probably having challenges because they were aggressive. They were trying to get top of market rents. They were paying top price. They were probably taking a lot of leverage. So I think, part of that concern is certainly kind of an intermediate, short to intermediate concern of where does the market go and what is the stability of some of these assets from a preservation perspective. The other thing that I think is interesting to watch is even the new transactions that are ultimately being executed with interest rates that are higher, with costs that are higher. Is that going to put even more upward pressure? Because if you're assuming a loan and that loan was executed 4 or 5 years ago, you're in the money. You probably don't have as much pressure to increase rents, especially in a softening, kind of fundamentals market. But new debt that's coming in at a higher cost of capital is probably forced to increase rents, which I think is going to create more attrition at the worst time, frankly. And so that's kind of a dynamic that we're watching that we think is really going to be telling. From a cap rate perspective, when you have rates that have more than doubled, and we've seen cap rates that have not more than doubled, but they've increased significantly. So there is still kind of this disconnect that's occurring in the market. Part of that is just there isn't a lot of inventory out in the market. I think once some of the the denial that is probably occurring in the market and the staying power is no longer there, we're going to start to see more inventory, and then we'll see a real market clearing price. Right now, a lot of the cap rates are in the mid to high fours, which for us is actually still too low. And I think they'll probably settle out. I mean, it depends on the market, but somewhere in the fives. And who knows, right, where anything goes, but it's still, it's been very much a rising market with a lot of uncertainty. I think from our perspective, what we're trying to do is just, look at the fundamentals of the asset, look at the fundamentals of the dirt and location, identify opportunities where we feel that we have some sort of operating advantage, right, that we can truly drive value. And we're not looking at cap rate compression to, really save the day. And those are kind of the principles that I think will stand the test of time, and also make sure that you don't over leverage. So all those things have been, kind of signatures of our investment philosophy, and still actually ring true today, if not even more importantly. So that's kind of what we're seeing and how we're kind of viewing, the market today.
So thank you. That's helpful. I think it ties in nicely with kind of capital sources, credit. Two things I want to touch on. One, would love to. I saw that you recently, started a credit platform. So kind of what is the goal of doing that in this market environment? What do you hope to accomplish? Tell us a little bit about that. And then two, I think it's interesting because, when we first met many years ago, your capital was primarily high net worth investors. You were raising capital and transacting on a deal by deal basis. And now, you can give us the details, but you're an institutional investment manager in addition to that, or in place of that, you can tell me, and you have an institutional fund with institutional capital partners into an asset class that sometimes is perceived to be too risky by institutional capital because of all the things that you just said. You've painted a very compelling picture of the social aspect in the double or triple bottom line. But for some institutions who don't have the ability to get so close to the operator, to get so close to the asset, to truly understand it, you say affordable and they just think risk. So maybe you can kind of talk to us about, what you've learned both, through the launch of your credit platform, but also the transformation of your business from a non-institutional business to an institutional business.
Yeah. I mean, it was very acute to me when we started this business that this was a business that was hyper inefficient, just not a lot of institutional capital. I even remember I would go to in this institutional investment firm's office, and I won't name names, but we were talking about workforce housing as a legitimate asset class, and they said, "Listen, I get why you're saying it. I get the numbers, I get the statistics, but never say that outside the hall because you'll be tarred and feathered." I think that's what represented the opportunity, because you get this herd mentality, and it's all about risk, right? And understanding risk. And folks that, either don't have the information or don't have the willingness to kind of really understand a market or dig deep or roll up their sleeves, then you're really not going to understand the risk. And I get why those positions and those perceptions were kept. Now that has changed in a very meaningful way over the last 5-6 years from institutions, as more data has actually surfaced and was validated in terms of the just the strength of workforce and affordable housing. It's pretty simple. The industry has insatiable demand and supply that's contracting quickly. And so when you have those dynamics and you demonstrate that through data, you can demonstrate the liquidity of the asset class. You can see just governmental agencies and GSEs like Fannie Mae and Freddie Mac and the regulator FHFA that are actually trying to push more of this business and provide more liquidity and provide better terms and rates and providing you kind of financing arbitrage. That data and that information is compelling and too important to ignore. And I think that's why there's been so much interest in this space. And so, from our perspective, that's great for, more investment in the space and shoring up the asset class. It provides more efficiency, which I think is good, particularly from an exit strategy perspective. But I think what it really does, it puts more pressure for owner operators to differentiate, right, and to drive true alpha. Because if capital markets are coming in and commoditizing at some level, you really need to demonstrate from an operator perspective that you're doing something different to truly drive value. So I think that's what kind of the next, if I'm looking ahead, the next generation of workforce housing is. I still think there's going to be institutional investors, but there's going to be a premium and a strong desire for operators that, really know what they're doing, are experienced, have some level of vertical integration, and offering something unique.
So the SEC has recently come out with an increased focus on greenwashing, and not only on the environmental side, but also on the social and governance. You mentioned this need to be more differentiated. When you zoom out and you go back to your experiences when, you were sworn to never utter those words outside of the four walls that you were in, what do you think our industry needs to do when it comes to, let's not focus on environmental so much right now, because there's a lot of talk on that. But, when you think about the social impact and you think about the affordability, the housing affordability crisis, what is it that our industry needs to be focused on in order to solve this problem, the systemic problem that exists today?
A multitude of things. I think, we talked about supply earlier. I think that's one of the biggest pieces, frankly. And I'm not just talking about new supply and new creation. I think we need to find innovative strategies for preservation. It's significantly cheaper to preserve a unit at certain income levels than it is to create new. And it has the added benefit of not having, as much carbon, impact. And I know we want to keep this on S&G, but it has that double benefit of having a social support of providing more affordability and actually reducing kind of carbon consequences. The other piece is also just, focusing on the customer and the community. And I know that seems pretty abstract and not everyone can underwrite to that or P&L, but it makes a difference. I mean, you don't have products like Starbucks and Disney and, Coca-Cola and all these really valued brands that arguably are commodities, right? But they create outsized value because of the experience, the quality, the texture, the message, all the things that come along with those brands and those products and those experiences. And so I look at multifamily in a very, very similar fashion. And we got to get out of our own way. We got to get out of, and I remember this very vividly when I got into the business originally, where I was talking about doing, having a soccer court in one of our communities, and we had property management companies say, "Oh, you don't need that." It was a tennis court. Nobody used it. It looked like, an apocalypse sort of situation, something you see in a sci-fi movie. It's pretty depressing. But the default response is, if it ain't broke, don't fix it, right? For me, it's, if just because it's, it ain't broken doesn't mean it can't be better. And I think, part of that is what we need to be focused on as well. And then lastly, I'd also say that, just in terms of our industry and how we message what we do as an industry, there's a lot of great people in our industry. We do a lot of, there's a lot of philanthropy, and even on the social impact piece, I think we need to be, carrying that message so that really public perception understands that, we're an ally, and we are aligned, because what's good for communities and what's good for residents is good for the industry. And that's where that partnership takes form. And, you can do that on a public stage. You can do it on a political stage. You can also do that as an industry by creating standards and frameworks. So I work with the Multifamily Impact Council that's creating frameworks and standards for social and governance in particular, and diversity, equity, inclusion, so that there is kind of this rubric that everyone can understand, and a common language that people can understand and rely on to provide transparency, and aligns with kind of UN SDGs and GRESB and all these other things, that all these other frameworks that haven't figured it out because it isn't as specialized or contextual. And I think that also will help kind of illuminate the work that we're doing, and help solve at least one piece of the puzzle.
Well, I think that's a great place to wrap up. We've covered a lot of ground. We talked a little bit about the founding story of Comunidad. We talked about what affordable and workforce means to you. We talked about the impact that you're having, the current tailwinds in the industry. We covered a lot of ground. There's a lot more that we could cover, but in the interest of time, Antonio, thank you so much for joining me today. If anybody wants to reach out to you or learn more about Comunidad, what's the best way for them to find you or get in touch with you?
Yeah, comunidadpartners.com, or LinkedIn, just Antonio Marquez. Feel free to just ping me. I'm open. I'm always, willing to help people that really care about this work and are dedicated to it. So please reach out to me. And Brandon, thank you. Thank you for having me on. Always fun to hang out with you and talk through this. And you took me down memory lane, so it's always nostalgic, and I really appreciate you and talking through these themes and these topics.
Likewise. Thank you, Antonio.